On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to The Money Path. I'm your host, Todd Schoenberger, and joining me today is Adam Hyman. He is the managing director at Metropolis Capital Advisors, and he's joining me out of Dallas, Texas. Adam, welcome to the show. We have to talk about this staggering amount. As you know, investors right now are very concerned with commercial real estate in regards to the so-called maturity wall. There is some $1.5 trillion in commercial real estate loans that's maturing at the end of this year. How do you think investors are looking at this from a refinancing risk or even potential distress across the market?
It's a great question. It's really what we've seen throughout the pandemic is extend and pretend. A lot of the banks, a lot of the lenders, they haven't wanted that wall of maturities to hit the market, so to speak. So there's been a lot of extensions, a lot of loan modifications. But really, I think the big story, what we've been seeing over the past few years is it's equity, equity, equity instead of location, location, location. Whether it's a purchase, an acquisition, a value add, industrial, multifamily, a development, the equity is just not out there right now, whether it's ground up, whether it's acquisition. So, large, big name sponsors, funds, smaller regional players just can't get that equity need. So we're having to be more creative in the capital stack, whether it's a stretch senior, whether it's preferred equity, whether it's bringing in C-PACE, something to be creative because the LP traditional equity on most transactions is really hard to come by. And that's what we're seeing as a really big handicap right now on transaction volume.
The LinkedIn reported that upwards of 20% of commercial real estate is vacant right now. Do you see this changing anytime soon? Will the numbers be squeezed where people are going back into the office, or are you expecting that vacancy rate to widen?
All we heard through COVID was death of the office, right? I mean, is it going to come back? How is it going to come back? What's going to happen to urban centers? What we're seeing right now is general occupancy, if you will, is about 53% utilization rate, I should say, over office spaces, across America. Occupancy is now hitting 110% for some of those assets. What that means is there's a lot of vacancy still in the buildings, but the utilization rate is much higher. So there's hot desking, there's shared working space. Most white collar jobs, law firms, accounting, even what we do, people are sort of adopting to that 3-day work week or 3-day mandate being in the office. That sort of it seems to be the standard nationwide. So I think it's still a big problem. I think it's still sorting out, particularly in the office space. A good friend of mine here in Dallas was recently in a very high profile law firm here in Dallas as well. Incredible build out. They're charging $2,000 an hour. There was no one on the floor when he was in there for a meeting. So a lot of people are still working from home. They're having the nice trophy asset. They're having the location to meet with clients. Utilization rates have come up. Occupancy is up for those spaces that are being occupied. And it's a bifurcation of the market. You have the trophy assets, the great locations, all the amenities, they're doing well. And, the B and C class offices, there's a reckoning coming. Some of those have been repositioned. Some of those won't be able to be repositioned. And I think that's where we still, I transacted on a really interesting office out of bankruptcy here in Dallas last summer. And that's what we're seeing. The sort of mid-tier, mid-location it's not quite terrible. It's not quite great. Those are still struggling.
I know you're in Dallas, but you cover commercial real estate nationwide, coast to coast. All I keep hearing about is how many people are migrating to the state of Texas. I'd imagine Dallas, Austin, Houston are just booming right now. Are you seeing vacancy rates come down there? And are you seeing that influx that national media is trying to tell us that everyone is moving to Texas?
Absolutely. I mean, and Dallas is, I came here in 2012 and the growth hasn't stopped. So it is just booming. It's uncontrolled. It's going crazy. I mean, whether it's multifamily, whether it's office, whether it's condo, whether it's hotel, it's doing well. Industrial, everything. Of course, everything is dependent upon location, asset quality, submarket. There's a lot of fundamentals that go into that. Texas is doing great. an interesting sidebar is the capital really, over the past 5 to 7 years has really dictated where the investment is going, right? As we talk to lenders, we sit in the middle between, the capital markets and the clients and the sponsors. So we're placing the debt, we're placing the equity, and it's a very interesting place to be, particularly over the past 5 years, because as we're talking to banks and lenders and CMBS and conduits and whatever, they're saying, well, here's where we'd like to invest, and it's typically we like the Sun Belt states. We're not investing in the Northeast, or we're not investing, in the Pacific Northwest. So some of that flight of capital and human capital and everything is being dictated by the capital on where the investments want to be and where people want to build and where people want to acquire and develop and so on and so forth. So there's a lot of things structurally happening, but it doesn't mean that there's not good deals, in Chicago or Idaho or somewhere else. But yes, largely the Sun Belt states and the Smile states have really boomed post-COVID and through COVID. I don't see that letting up anytime soon. People are really, drawn in by regulation and climate and power and all those things. So doesn't seem to be a let up for that anytime soon.
Yeah. Idaho is popping. Yeah, that's right. So what about places like a company like a WeWork or Serendipity Labs, where you have this, you could rent out an office for, 9 to 5. I mean, are those growing in popularity?
I'm personally not that familiar with the WeWork space. We haven't transacted on any shared working spaces, so to speak. So can't speak too well to that. I mean, I think some of that has sort of tapered in demand and need post-COVID. There's certainly a proliferation of those shared working spaces. And you go to any submarket, even here within Dallas, there's not just WeWork. There's competing styles of the same thing in a lot of office buildings, a lot of locations. They serve a need. I think they serve a need in the current environment where a lot of white collar jobs don't need to be in the office 5 days a week. So, helps fill up vacant floors in office buildings where landlords are trying to, get any revenue they can or try to stabilize an asset. So serves a purpose. There's no shortage of them. And, I think particularly in big urban centers, I don't think they're going to go away anytime soon, but there'll probably be more consolidation again into the bigger and better assets.
Your firm is headquartered in the Washington, D.C. area. I know you're in Dallas, but all the hot shots are in D.C. So data centers have been booming in Washington. That actually is the nucleus, ground zero. That's where we really first started seeing big data centers installed in a big city. How big of a capital markets outlook is this for the AI side? Because AI data centers, as you know, are now being built up coast to coast.
Tremendous, right? I mean, again, what is the old adage in real estate? Location, 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 right? What is it for AI data centers? Power, power, power. So, these are driven by power, 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 right? Cheap land, favorable regulation, and good climate, right? These are very sensitive centers. What's in Northern Virginia, you mentioned Washington, D.C. Northern Virginia handles 70% of global internet traffic. A lot of people don't know that. But what we're seeing with these AI mega data centers, they're creating their own clusters around the country, including here in North Texas and Dallas, Phoenix, I think some in Atlanta. But they're being driven by where's their cheap land, where's their great access to power, and potentially behind the grid power sources like solar, battery storage, gas. But what's interesting is they're really not traditional real estate plays. These are utility scale assets. So these are really being project financed like a utility, like a major factory infrastructure type investment. These aren't necessarily hitting the real estate capital markets. These are $500 million to $1 billion facilities, and they might employ 50 people, 50 highly technical engineers. So they're not creating a lot of jobs. They're using a ton of power. They have very specific places they need to be. And it's your typical food group of companies who are doing these, right? Amazon, Microsoft, Google, Oracle. They're the ones, they're buying up $500 million pieces of, old, suburban office locations or places where they can tie in and do what they need to do. Whereas, most of the deals we're involved in, let's say, are, up to $200 million in cost or development. That's really sort of the middle market of what we're involved with. Not many capital groups like us are financing these AI or data centers, because these are really, you think of them like a utility, like a major factory, like a power plant. That's really what they are. They need tremendous cooling. They need a lot of water, a lot of power. They need, cheap land. Along with that, we're seeing, a flux of, I think you're asking earlier as well, like the changing American city, and, secondary, more affordable cities, headquartered around universities like Knoxville and Tulsa are seeing a more flight to affordability, as some of the Sunbelt cities have become unaffordable in this latest boom.
Yeah, no, you're right. And also those data centers have a 90% profit margin, so they're not going to stop anytime soon. On the institutional capital, though, which sectors do you see money flowing into the most? Is it data centers or maybe multifamily? I mean, are there areas that are in favor these days?
I mean, historically, we all need to sleep, right? Everybody needs a bed. So in the long run, a well-placed multifamily in the right markets at the right yields and the right, cost and the right locations are going to do fine. Same thing for office, and same thing for industrial. I think there's been a lot of capital flowing into those three sectors over the past, 5-6 years. I think what you are going to see that's very interesting is, there's been some headline risk recently in private credit. All the equity has become credit in the past 5-6 years, because when rates rose, people didn't want to take, equity like risk. So they say, hey, I can lend money 10, 11, 12%. Sure, I'm going to do that. I don't want to be at the equity position in the capital stack. So there's just been an explosion of credit funds or, groups that are saying, you know what? Yeah, I'm not going to be in your LP or your JV equity. Yeah, I'll lend you up to 75% of the capital stack instead. So I think if rates continue to come down, I think we're going to see a flow out of traditional private credit to some degree and into mortgage REITs, because as rates come down, homes become a little bit more affordable. People are going to, mortgage rates will come down accordingly. And I think there's going to be some shift in that aspect. I think that's sort of where we're going to head, depending on what happens in the economy.
Yeah, well, you beat me to it on the private credit side. I was going to ask you that as the closing question. So we're hearing a lot about private credit concerns. Blue Owl is one of them, KKR. With that, and a lot of these companies, as you know, provided capital for software development, et cetera. Are you concerned at all of what you've been reading about private credit? Should investors see this as a potential disaster like we saw in 2008?
Hard to say. I think that, look, certainly there's that potential out there. It depends on which firm, how strict in quality was their underwriting and how they placed their loans. I always say, if you look back at the GFC, and there's always, everyone still refers to The Big Short and the whole story around that, right? Mm-hmm. He ultimately did something that was blatantly obvious to him, but not to everybody else in the market. So what I've seen, over the past 5 years is like I referred to earlier, there's this incredible need for equity in real estate transactions with great sponsors, with, people with 35-year track records, and they've built, 25 buildings, or they've successfully exited, 20 plus deals, and they can't get the equity. So I think the smart money, instead of, saying, oh yeah, we're going to lend to 60-70%, should be on the equity side. Now I'm moving to the equity side, because the equity is really controlling the deal and controlling most of these transactions, and can. So yes, I think there's been a huge proliferation in credit. I think the smart money is going to do what going opposite that a little bit, and we'll see what happens. But there's always going to be a shakeout. We work with hundreds of lenders across the country, and I've lost track of, we get people reach out to us every week on, we're another bridge lender. We're another, and they're all the same. It's the same investment box. It's the same lending criteria. It's the same geographic interest. It's the same rate. And ultimately, we're going to take our clients to the firms that we trust the most, that we've closed the most, that we've had the most faith in. But there is no stop to what I've seen, in the past year of new credit funds and new lenders and that are reaching out to us and looking for deals. But again, we're not seeing that on the equity side. We're seeing that on the credit side. And I think, the smart money should shift back to the equity side, away from some of that credit.
I think you're going to see that. I mean, absolutely, especially when you have so many headlines out there on the private credit side, you will be seeing that shift. And especially as these loans are maturing and there's a lot of restructuring that's taken place. Adam, we got to talk more later on. I know you got to go. You're very busy out there in Dallas, but I'd love to have you back later on this year to really follow up on this discussion, especially on the private credit side, see if there is a migration to equity.
Thank you. My pleasure. Anytime. Thank you for having me.
Absolutely, Adam. So on behalf of Adam Hyman, I am Todd Schoenberger. Thank you once again for joining us on The Money Path. Coming up at 2 o'clock live, we have Jose Torres, senior economist from Interactive Brokers. He's going to break down that CPI number and get you ready for Friday's PCE data. Until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic fam, guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family line.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.